we'll keep kind of looking. One of the things that I thought I'd do is talk about quantitative investing. So there's a lot to do in quantitative investing, and I think a lot of people sort of get a little bit scared of quantitative investing. And what I thought I'd do is create a really basic algorithm that I'll show you guys kind of how to do. And what we can do is maybe even collaborate a little bit on it, where we can sort of create and backtest some of these algorithms and sort of see where things come out. This is a very kind of, how should I put it, basic algorithm that I still think is kind of neat. And it's I'd say 80 or 90% quantitative and 10 or 20% fundamental. I don't like, there's sort of two ways to think about quantitative investing. The first is kind of microstructure quantitative investing, which has to deal with very, very short-term trading. Some people call it high-frequency trading. I don't like that kind of quant investing. I don't think anybody should really do it, to be honest. It's kind of becomes more like a video game or a structural inefficiency. You can go buy data for microseconds, advantage above your competition, and try to out-trade them in that kind of environment. I don't think that that's a really wise thing to do. It becomes an arms race, and I think it has questionable legality. I like the short term to intermediate term, not the ultra short term, but the sort of intermediate term quantitative investing. So I actually like about a 1 month time frame. And I think that that's sort of where the future of so-called quantitative investing, or statistical arbitrage is another word for that, is. And there's a sort of a pairs trading methodology taught to me by one of the founders of D.E. Shaw, and I'll share a little bit of it with you now. And so in essence, pairs trading involves going long. I guess I didn't explain that here. But pairs trading is going long one stock and going short another, so that you're, market neutral. So a good example would be, going long a pharmaceutical stock and going short another different pharmaceutical stock in the same amount would be a pairs trade. And what you're trying to do is you're trying to gain some difference between the two. Obviously, you hope your long goes up and your short goes down, but at the same time, there's some expectation that maybe both stocks will go up, but your short will go up less than your long, and you'd make money, or vice versa, that both stocks might go down if the market goes down, but your long will maybe be a little more insulated than your short. So there's a few different ways to do it in terms of pairs trade is a form of a hedge. It's not exactly the same. Hedge can be kind of any kind of thing that mitigates your downside, but a pairs trade is being long and short, sort of generally speaking, not always, but generally speaking, similar companies like a food company or a pharmaceutical company, having them both long and short. It's different from hedging in the sense that you could hedge a portfolio, say, with options, whereas pairs trading is, if you're long Boeing and you're short Lockheed, that's a pair. They're a natural pair in a sense. So in any event, what I like to do is take an industry like, say, pharmaceuticals, something I know relatively well, and go back as far as I can with data and rebase all the prices to one. And so the prices change based on that rebase. So I can show you a little bit of what I mean. Let's see here. Okay. So if you go back down here, this is 2010, so it's about 7 years ago. This is the Merck price for 2010, and in 2010 terms, the stock price is $33.71, but it doesn't really make sense to pick an arbitrary number, so I'd rebase it to 1, and then you can see that the stock price changes according to this rebase, and you have it at $1.87. So if you change all of them to $1, you can make some comparisons. And then you might want to also roll, I do this rolling rebase, which is another sort of way to do it. So this is every 30 days, in essence, it sort of resets. So you get this different rebase. So you can do this a few different ways. And if you normalize them enough, what you do is you'll end up being able to compare them. So say the relationship between Merck and Lilly or Merck and Pfizer. And the reason this is really interesting is that it makes sense that a group, an industry, should have all the same benefits and all the same drawbacks. And that Merck might outfox Pfizer at one point, but all the same resources are available to all of these companies. And obviously, if a company takes a dramatically different strategy, like it says that, well, we're not going to do, we're only going to focus on cancer, that would have been a very handsome strategy to take 10 or 20 years ago, or 15 years ago. And so that company may stand out. And there's ways to sort of control for that kind of change in the nature of a company. But in general, a group of companies in any one field sort of have the same they have the same resources available to them. And while one company may do better than another, you can argue that delta is going to be due to chance and not really due to something that you can predict. So the reason this is interesting is that if it's true that an industry, that the inter-company differences of the industry components will travel in a band, then one can hypothesize that a reversion to mean phenomenon will take place. In other words, that if one stock of the industry, say Eli Lilly or Merck, outperforms another stock, say Bristol Myers or Pfizer, that it's likely that those relationships will collapse again and the mean will revert. And this is a very basic quantitative concept called reversion to mean or mean reversion algorithm. And it was popularized, I think, by D.E. Shaw. Again, companies like these, Renaissance, D.E. Shaw, Two Sigma, etc., are control their algorithmic trading secrets very carefully. But I know this is a pairs trading phenomenon for equities that D.E. Shaw does quite a bit of. So what I did is I took the rolling 30-day rebased relative performance. And what I did with that is I tried to take a reversion to mean pair trade at -2 and +2 sigma. So in other words, if these are two of the relationships, if you can see here that the relationship blows out to the upside, that I would take the other side. So if let's say this was Lockheed Martin and Boeing, I would the relationship between the two is a ratio that centers around 1. Then in essence I would go long Lockheed here and short Boeing, and maybe here I would go long Boeing and short Lockheed, and back and forth. And this is really interesting because this is much easier than so-called technical analysis, which I don't really think is a real phenomenon. This is sort of a fake phenomenon that we humans like to make things simple. But you can see that this is a really reliable relationship, that there's always this reversion to mean without a blowout. When I say blowout, I mean something that is such a big delta that it will blow you up if you have the trade on. And so these are totally different signals, and these are really good signals that you can take and almost certainly make money on. So I did this 2 sigma strategy. What I found was that I got about a 20% IRR, which is pretty incredible, but maybe even more incredible was that there's this scalability that comes with this type of trade where you can do $100 million trades here and make money repeatedly, and your bite size is relatively small. So I thought it was a pretty cool algorithm. I encourage you guys to share your algorithms with me. You can email me. I share my email at the end of the program. But the most important thing I think in quantitative investing is that the algorithm has to stand to reason. That just because you find a correlation, if there's no causality or no sort of implicit causality, then you're going to have a very hard time justifying putting real money behind the trade, because you really have to start with the theory and then build your algorithm. I think a lot of people start with the algorithm and then pray there's some theory attached to it, and I really don't think that works. So, if anyone wants to sort of play with some of these relationships and some of this data with me, you're more than welcome to email me and start up some quantitative investing research with me. And